Robschild. No investment advice. Welcome to the show where we view financial markets through crystal ball gazing. J.P. Morgan once said millionaires don't need astrologers, but billionaires do, and so we begin. Today is Friday, August 16th, 2024. Today's episode, Major Trendline Destruction. The world of trendline analysis has been getting extremely wild lately. If you take this October 2023 low, connecting it through April 2024 low, and very recently we had broken through this trend line. Every time you hit a trend line, it gets weaker. So we hit it at least 1, 2, maybe 3, maybe 4 times. Maybe you count it as a total of maybe 3 times. Each time it's weaker, and we finally broke through it. It would be very normal for us to come and retest it. On a breakthrough like this, a line like this is normally very, very strong. It's actually at its strongest when the market goes back up to it for the first time to try to test it. This is an area where a lot of professional money will be shorting right at this line, assuming that it'll get rejected and go the other way, or even slightly above the line, because if you don't have a confirming candle closing above the previous close, then it can also be bearish. But today, we settled closing higher than yesterday's close, confirming that this trend line has now been destroyed. It no longer exists as a meaningful trend line. This is very significant, especially considering that this is the S&P 500. This is SPX. This isn't some random penny stock doing crazy things. This is the S&P 500. So it's very, very wild, crazy to see this here. As old patterns die, new patterns emerge. And I'm beginning to smell, with my crystal ball, a head and shoulders, some head and shoulders coming. If we take a weekly view of the S&P 500 and take this previous bottom from April 2024, connect it to this most previous bottom, we're starting to see a fairly clear and very beautiful, smooth, very controlled looking potential head and shoulders. As long as we don't close above the previous high. This is a weekly chart of the S&P 500, and if we were to crack below this line here, well, this has all of the classic signs of being a perfect head and shoulders. It would be symmetrical. It has an upsloping neckline here at the bottom, and it is at all-time highs, which means, normally the pattern to play out here would be from the top of the head to the neckline. You'd expect that the break to be from the break to the same distance. So that distance there, the same as the top of the head to the line. However, these patterns also very consistently represent tops in markets, or they can also represent on the inverse side a bottom in a market with an inverse head and shoulders. I'm quite certain I'm not the only one sniffing this out, and simply other people sniffing it out can actually have an effect on it playing out. So with me and my crystal ball, I see this as a pretty high probability possibility playing out very soon. Remember, on the daily, friends, the 2-year, 10-year yield curve has been inverted for over 2 years. I don't believe this has ever happened before in history, suggesting potentially the worst recession or depression in a long time. We've also had the SOM rule triggered. This is triggered when the unemployment rate is rising at a rate that is unstoppable, typically, and it's been triggered, which suggests that the recession has started, that it's here. This adds a lot of weight to the potential of this head and shoulders being the top. Very similar, pretty much same pattern in the Qs, the NASDAQ 100. This is where we are now. I think this is likely. Same thing in SMH, the sort of leader of this whole AI bubble in the first place. I mean, my crystal ball here, to me, is fairly clear here. I am predicting and fully expecting for it to play out this way at this point. Not only is dumb money in very popular stocks like SMH, the semiconductors, not only is that showing head and shoulders top along with the indices, the S&P 500, the NASDAQ, but even wood is starting to look like we might be seeing that pattern or some similar form of that pattern, suggesting that a lot of stars are aligning for this to play out this way. Add to this the VIX futures term structure, expecting a spike in October, currently priced equal to all the way out to the February contract, higher than all of the ones in between. This is very abnormal. You want, normally the time costs money. The market is sniffing out October. This is it. This is the big crash here. The price of the VIX, along with Mr. Market, has just been going down this little ski slope here, so controlled. Incredible how orderly this sell-off in the VIX has been. Just every day, it's just a perfect curve down. It's astounding. With the markets being at all-time highs and breaking this epic trend line that I don't think anyone expected to break here, I'm going to suggest that Mr. Market gets dumb sometimes, and right now is evidence of those times. The retailer is in charge here. The low volume in markets can add to evidence of the fact that retailers are really moving markets here, with the institutions just waiting to pull the rug. At this point, it feels to me like desperation of junk bonds, of people seeking higher yield here. It's just me and my crystal ball, but the feeling that I'm getting from what's going on here might be akin to the way people might feel at the end of the world, where it's like, we know the world's going to end in a week, and so might as well go for that higher yield, the last hurrah. Credit spreads being so tight here right now in very dangerous waters. It's unbelievable to see what's going on here in markets right now. If I am correct with my crystal ball, and even if I'm not correct, rates can still go down and TLT can benefit. I find it notable that we are in a very orderly, very, very, very clear flag here on TLT. This is going to break early next week. It's just a matter of, is it going to break up or is it going to break down? Either way, I'm still going to be holding my positions of long treasury bonds. Normally I'd say TLT looks like a bull flag pretty clearly, but when I open up the yields, especially the 10-year treasury yield, it gets a little bit more nuanced. Only because if you look at it from a much shorter time horizon, you could see this as, believe it or not, a bull flag on rates. And so it would actually be from this short-term pattern looking like it would want to actually break higher from here. Maybe this would be when we finally test this line of the very long-term head and shoulders that I've been talking about on previous shows. However, when you zoom out a little bit, you might consider this to be the opposite, where we have actually a bear flag coming from down here, which would suggest that it would want to break to the downside. That's all I have for you for today's show. I hope you enjoyed, and thank you for watching. Robschild.